So, you're looking to dive into the world of Wall Street without losing your shirt? Smart move. Investing is basically the closest thing to a cheat code for life, provided you don't treat the stock market like a Vegas casino. We're going to break this down from the absolute basics to the nerdy stuff that actually makes you money. Buckle up, because we're going from $0 to portfolio goals real quick. This isn't your grandpa's boring financial lecture. This is the real deal on how money actually moves in the modern world. We are talking about building a literal money machine while you sleep, eat, or play video games. A lot of people think you need to be a gray-haired dude in a suit to buy shares, but honestly, the best time to start was yesterday. If you're wondering how to invest in stocks teenager style, the secret is a little thing called a custodial account. Since you can't technically sign legal contracts until you're 18, you'll need a parent or guardian to open the account with you. The beauty of starting as a teen isn't necessarily the amount of money you have, it's the time. Thanks to compound interest, a few $100 invested now can grow into a massive mountain of cash by the time you're ready to retire. You're essentially letting time do all the heavy lifting for you while you're out living your life. Just think about it. If you put away just a bit of your birthday money or paycheck from that summer job, you are literally buying pieces of the biggest companies on the planet. Just make sure you're using an app that's user-friendly and doesn't hit you with crazy fees every time you want to buy a fractional share of your favorite tech giant. Being a young investor is like having a superpower that older people would pay millions to get back. Don't waste those years waiting for someday. All right, so you're hyped and ready to go. But how do you actually get your foot in the door? Let's talk about how to invest in stocks from scratch, creating account logistics. First, you need a brokerage. Think of a brokerage like a bridge between your bank account and the stock market. You've got plenty of options these days, from old-school giants to sleek mobile apps that feel like playing a game. When you're creating that account, you'll need your social security number, your address, and some basic bank info. It's basically like signing up for a new social media profile, but with more adulting involved. Once the account is verified, you'll link your bank and transfer some seed money. Don't feel pressured to drop thousands immediately. Most platforms let you start with as little as $5. The key is just getting the plumbing hooked up so you can actually place your first trade. It's a pretty straightforward process, but it feels like a huge win once that account active notification pops up. You aren't just a consumer anymore, you're an owner. That shift in mindset is worth more than the actual dollars in the account. Now, we can't just pick stocks because the logo looks cool or some guy on the internet told you it's going to the moon. If you want to actually win, you need to understand how to use financial statements to invest in stocks properly. I know financial statements sounds like a total snooze fest, but that's where the truth lives. Companies can say whatever they want in commercials, but they can't lie to the SEC about their numbers without going to jail. You're looking at three main things: the balance sheet, what they own versus what they owe, the income statement, how much money they're actually making, and the cash flow statement, how much actual green is moving through the building. If a company says they're disrupting the industry, but their financial statements show they're hemorrhaging cash like a leaky faucet, you might want to think twice. Learning to read these documents is like having X-ray vision. It lets you see if a company is actually healthy under the hood, or if it's just a shiny exterior with a broken engine. You want to see growing revenue, manageable debt, and a moat, something that keeps competitors from stealing their lunch. When you master this, you stop gambling and start calculating. Sometimes you don't want to wait 30 years to see a return. You might be looking for a quicker turnaround to boost your bankroll. When researching how to invest in short-term stocks, you're shifting your mindset from growing with a company to capturing a trend. This usually involves looking at technical analysis, those wiggly lines on a chart, and keeping a close eye on the news cycle. Maybe a company is about to release a massive new product, or there's a seasonal trend that always bumps a certain sector. Short-term investing is way more hands-on and carries a bit more risk because the market is super volatile in the short run. You've got to be disciplined, set your stop losses so you don't get wiped out if things go south, and realize that you're playing a different game than the person who buys and holds for decades. It's high energy, it's fast-paced, and it requires you to be glued to your screen a bit more often. You're looking for patterns, momentum, and volume. It's stressful, but for the right person, it's a rush rush like no other. One of the biggest mistakes newbies make is putting all their eggs in one basket. If you put all your money into one hot stock and that company has a bad scandal, your whole portfolio goes down the drain. This is why we talk about diversification. You want a mix of different industries: tech, healthcare, energy, maybe some retail. Think of it like a sports team. You wouldn't want a team of 11 quarterbacks, right? You need some defenders, stable, dividend-paying stocks, and some fast runners, growth stocks. By spreading your money out, you protect yourself. If one sector has a bad month, another one might be killing it, which keeps your total balance from crashing. You can even look into ETFs, exchange-traded funds, which are basically a basket of hundreds of stocks bundled into one. It's the easy mode for diversification. Let's keep it real. The stock market is a giant emotional roller coaster. One day you're up 5% and feel like a genius. The next day, the news reports a market correction and you're down 10%. The biggest pro tip I can give you is to keep your emotions out of it. When the market dips, that's actually a sale. You're getting great companies at a discount. Most people panic and sell when prices go down, which is the exact opposite of what you should do. If your research, remember those financial statements, tells you the company is still solid, then a price drop is just noise. Stay the course, keep a level head, and remember that the market has historically always trended upward over the long haul. You only lose money when you click sell during a dip. Be the person who stays calm while everyone else is running for the exits. Nobody likes talking about the tax man, but you've got to know the rules. If you sell a stock for a profit, the government is going to want a piece of that action. If you hold a stock for more than a year, you usually pay a lower tax rate. This is called long-term capital gains. If you sell in less than a year, you pay at your normal income tax rate. This is another reason why holding for the long term is usually a winning strategy. You get to keep more of your own money. Also, watch out for expense ratios in funds. Even a small 1% fee can eat up thousands of dollars of your gains over 20 years. Always look for low-cost options. Being cheap with your investment fees is one of the easiest ways to get richer faster. Every dollar you save on fees is another dollar that can compound for your future self. Building the habit success in stocks isn't about one big lucky trade. It's about the habit. It's called dollar cost averaging. This just means you put in a set amount of money every single month, regardless of whether the market is up or down. By doing this, you buy more shares when prices are low and fewer when they are high. Over time, your average cost per share stays low. It takes the guesswork out of timing the market. Nobody can perfectly time the bottom or the top, so don't even try. Just be consistent. Set up an automatic transfer from your bank to your brokerage and let the machine work for you. Before you know it, you'll look at your balance and realize you've built a serious bag without even feeling the pinch in your daily budget. Investing is a marathon, not a sprint. Sure, you see the overnight millionaires on social media, but for every one of those, there are 1,000 people who lost everything chasing a meme coin. Real wealth is built through patience, research, and keeping your cool. You're not just buying numbers on a screen. You're buying a piece of human innovation. Every time someone buys a coffee or a new phone or uses a search engine, a little bit of that money could be flowing into your pocket if you own the right stocks. That's the dream, right? If you made it this far, you're already ahead of like 90% of people who just dream about getting rich but never take the first step. Seriously, most people just talk about it, but you're actually learning how to do it. If this breakdown helped you feel a little less lost in the sauce, do me a huge favor. Smash that like button and hit subscribe. It really helps the channel out and keeps the algorithm gods happy so I can keep making these for you. Drop a comment below and let me know which stock you're eyeing for your first buy, or if you've got questions about opening that account. Let's get this bread together. See you in the next one.